Well, hello everyone. Thanks for joining in. I'm really excited to be interviewing Darin Rayburn, who is the former CEO of Melcor Developments and Melcor REIT. They still are a diversified real estate company. They have holdings and they've done developments in all types of asset classes, industrial, which we're going to talk about mostly in this interview. But they've also done a lot of retail, office, land, and even golf course development. So it will be exciting to talk to him about a variety of different things. Oh, sorry. Give me 1 second here. Get a background here. Give me 1 sec while I try and figure this out. We had a little bit of a technical difficulty getting going as well with just a power cord. But I do want to thank everybody for joining in. And again, this is live. So if you have any questions that you want to ask of Darin as we're going through this, please feel free to put it in the chat bar. And I do also want to thank everybody who's joined in all over the world. It's one of the really cool things about this channel is that it's reached every corner of the world. Last week, I heard from somebody in Saudi Arabia, heard from another guy in Guatemala. So Adele or Andres, if you guys are tuned in, great connecting with you, and I hope to chat more down the road. But I'm very fortunate to have people all over Vietnam, Korea, all over North America. It's been very exciting to talk to a number of different people. So if you're tuning in from somewhere outside of Canada, I know people from Ontario are listening and California are listening. If you're tuning in from anywhere in the world, I'd love to hear from you. Just leave a comment in the chat bar and where you're from and what you do there. And again, if you have any questions, we'll certainly take time to do it. But without any further ado, I'm hoping, Darin, you've got the situation figured out. Are we all good? Power is good?
Hey, Chad. Power's okay, and I've got backup coming. So thanks for bearing with me, everyone.
Awesome. Well, thanks so much, Darin. It's great to have you on the show.
It's hard to believe you can go from running a $2 billion publicly traded real estate company, but then you're short a power cord when you move into your own office, hey?
Well, I was going to point something out that you retired from those publicly traded companies in December, and in the last 24 days or so, the stock market has been in a death spiral down. So I don't know if there's something there or not. If you leaving is what caused the stock market to fall.
No, Chad. I'll tell you what. The fundamentals of the two Melcor companies are fantastic. They'll do fine. Let's leave it at that for now. It's one of the typical volatility that when you run public companies, you get used to feeling. And I still feel it as an investor, but I got to admit, I feel a little less this week. So that's kind of nice.
I bet it feels like you've got a lot less on your shoulders that you have to see. So I do want to jump into all that. I want to get your thoughts on your experiences when you were working with the Melcor and the development and the REIT capacity. And I also want to contrast that to how you're looking at investments going forward, because I know you have some of your own holdings and now you'll be looking at it as a private investor. So we'll perhaps jump into that. And I saw Thomas joined in. Thomas, thanks for joining in. Please feel free to say hello or ask questions as we're going through here. I love the interaction and building a little bit of sense of community around this. So please do say hello or where you're from and any questions for Darin as we go through this. So first question I'd have is, when you were the CEO of Melcor Developments and Melcor REIT, how did you typically analyze deals? How did you look at deals through that lens of being the head of a publicly traded company?
Well, and the fundamentals of real estate are always the basis of any deal you look at, whether you're running, a big public company or whether you're doing it on your own. So, that's always important, the market dynamics, the current opportunity, rent roll, building, physical structure. One of the things as a REIT, the REIT side of the business, which relies on consistent income, we also look at the story about the asset and the alternative use, because empty buildings in a REIT make it very difficult to pay your investors every month. So, I've had these conversations with other people in the industry who said, well, everyone looks at that. And I say, I agree with it, but it's a bit of a different lens, because remember, the reason a REIT is a REIT is because, REITs have agreed to pay a high level of their free cash flow to their unit holders every month. And what we saw during COVID, and we've seen other times, is when REITs have to cut that distribution, that's almost a death blow, because most investors in REITs are looking for yield and consistent yield. And so even in our situation in Melcor Developments, been around 99 years, development company, we have a much longer horizon. So Melcor will own a bunch of land, and we'll buy an empty building, and we'll sort of do that side of it. From the REIT side, unless a REIT has scale, you typically want to get cash flowing assets that are pretty consistent, Of course, you want to learn how to grow that cash flow. So that's the other side of it is, okay, so what's the story? If I buy it at an average rent now, how do we actually grow that? Because the only way to grow your REIT distributions is to grow your income.
So did you primarily look at it as organic growth, same store growth, or were you looking at to grow it through acquisitions, perhaps externally, or ones that you developed and then sold into the REIT?
A real combination of both. And the same store, the same asset NOI is really important because, and I'll be careful how I say this to not offend any of my former colleagues. Yeah. Like growth just for the sake of growing, just keep buying buildings and your income goes up. But the truth is like what is your bundle of assets doing? Is it improving? And that's why many REITs specifically, even development companies, will report on the same asset NOI. So that's important. But really, it's about the exterior growth that's so important. And that's why you saw such an explosion amongst REITs, from 2013 on. It was about buying scale and creating that bundle of assets and then looking at your organic growth.
So I did a poll to ask people what questions I should ask you. And the most popular one is the one that I was curious in getting your thoughts on as well, is the difference between investing in a REIT and divesting in private real estate. And I do want to get your thoughts on how you're approaching it yourself, but just for an average investor, somebody who wants to start getting into the real estate space, maybe they decided they wanted exposure to the industrial market because they hear it in the news, and they're looking at the alternatives between investing in a REIT or investing in direct ownership. How would you differentiate the two?
Investing in a REIT gives you an incredible amount of liquidity. You're not buying a building, then trying to market it for sale, then getting your offers and all the stuff that we've done all our careers. Chad, it's a bit different. Mm-hmm. One of the real benefits to investors in REITs, where you can still get the benefit of buying real estate and owning real estate and getting paid out your yield on the real estate, but having that opportunity to get in and get out whenever you can. Mm-hmm. Now, the flip side of that is it depends what REIT, because if a REIT is illiquid, it's not so easy to get in and out. But generally speaking, the whole REIT concept, the whole REIT model started by the capital markets trying to give people an opportunity to own real estate without actually owning their own building and everything that runs with the property management and the leasing. And so that's a really important part of someone who invests in REITs. They like that, and they like their yield. And so, for instance, for a company like Melcor Developments, it's been around for so long, people who invest in the shares in the development company, which is not a REIT, it's more patient. They're looking for capital appreciation in the shares. They're looking for the long-term growth and to see the shares go up. Whereas in a REIT, you may not get a lot of movement on the unit value, but if you consistently pay that distribution out, effectively the return is growing without the REIT units actually growing in value, if that makes sense.
Did you find that there were pressures for being a publicly traded REIT where your quarterly reporting is so prevalent and such a necessary part of the business, and there's all the analysts and all your investors that have those expectations of those quarterly earnings? Do you find that there is a bit of a contradiction or a paradox between that quarterly reporting pressure and the long-term objectives of real estate in general?
Oh, absolutely. And it's, again, not a criticism, just an observation. We always reported after the quarter, and we spent a lot of time talking about what we did. And I'd always joke privately to my boards, because there were two boards, to say, if we spent as much time doing the work as we were talking about how we do the work, I think we'd all do better. But it is important because people do look at the value of the shares. And we walk down the street in Edmonton, and you see Melcor shareholders all the time, and it's important. People want to understand. They want to understand where the growth is, and so we spend a lot of time reporting quarterly. And I can tell you, we're still long-term thinkers. You are, but still, when you have that investor call the day after releasing earnings, spend a lot of time sort of thinking about, what are the key points that come up? And it doesn't change your fundamental decisions about real estate, but it does put a little more pressure on timing, because you can only say, trust me, it's coming, for so long in the public markets. When people start to say, yeah, I've heard that from a whole bunch of people. So the other thing I learned quickly too is, and Chad, you and I go way back, and that I'm a salesman at heart. It's who I am. It's what we do. In the public world, you can't give forward-looking statements. Mm-hmm. And so you sort of learn, enthusiasm is great. Talking about, what you've done is wonderful. You got to be a little careful about talking about the future. You can talk about strategy, but you can't give the whole, things are going to be great, because That would be definitely called forward-looking statement.
Yeah, and I think that probably just speaks to those underlying pressures that you have, being a publicly traded company in general, is that you've got to be very careful with everything you say because it can come under intense scrutiny. So now that you've taken off that hat of being under the spectrum of that publicly traded company, potential criticism, how are you approaching it now as a private investor? And you started a company called Foray Developments. So what's the pattern on how you're going to approach this now? How are you looking at it from a development standpoint or even potential investments?
Well, it's a little different. I'll sort of knock on this. This brick building is a building I bought downtown 104th Street called the McKinney Building. Which we have I have a different view to it because it's a longer term view. It's a really cool building. Well, it's not historically designated. It is on the list. We like to do something interesting and unique, and we're not in a hurry to rush into it. And again, I'm not suggesting that other people are in a hurry to do things, but the lens changes a little bit. And for me, Foray Developments is I had a holding company, for the last 17 years that I did things that were not in conflict with my employer, but rebranded it into Foray, and the wording is on purpose because it's about something new and different and exciting. And so, again, as I mentioned earlier, when I talked about REIT investments on cash flow and the rest of it, I mean, hey, now I'm on my own. Cash flow is pretty important, but I'm also looking for those unique opportunities that maybe a big company that's flying over an economy, a city, doesn't quite get to see those. Whereas you're on the ground and you're slugging it through the back alleys, and you've been around these markets long enough. So my hypothesis, my investment hypothesis is to stay in the markets that I know and that I have contacts in and I know people, and find those opportunities that I'm not going to be competing with a whole bunch of companies, a whole bunch of big companies. It's nice bite-sized niche, but I'm looking sort of for that excitement. And again, running two public companies, I can tell you, was incredibly exciting for many years, and I love that. But for me, where I was in my life and my time, I'm 53 now. I love the deal side of it. You and I have talked about that before. And I think this gives me an opportunity to still look at those deals that aren't just fitting in one box, but that are fitting in, a host of boxes. And so it's not a specific answer you'll see on my Foray website yet, Chad, but I really want to, pursue those cool, unique type things that you can have fun and you can show off.
Almost like the trophy assets kind of idea.
Totally.
So I still do want to explore some of the differences between REITs and private ownership, and that might be a good point to even just get into one of the questions that came in from Kevin Gardner about how you acquire properties using debt. When you were doing it through the publicly traded company, did you do typically the same type of financing as you'll do as a private individual, or were you selling bonds and raising capital that way, buying it in cash? How are the differences do you see going forward between how you purchase as a REIT and how you plan on doing it going forward?
Sure. Chad, I was really fortunate because I got to do a whole bunch of things in the public markets. So, we've got, you do traditional financing is one way to finance as well. You sell REIT units. That's how you raise money. The challenge with that, if the shares have gone down and your yield is up, and say a yield is 7% that a unit's paying, if I'm selling a REIT unit to you, Chad, to raise money, my cost of capital is 7%. So that's a challenge in today's economy. I've also been involved in convertible debentures, which is, just a different form of debt stack. We've done subscription receipts, we've done different things. So what's really cool about the capital markets world is the products tend to move depending on the economy, because the capital markets world works if we can keep placing money in one way, shape, or form. And then, your question is, how's that different now? On a different way, to me, depending on the assets, depending on the opportunity, I see a lot more opportunity for syndication. A lot of like-minded people who want small pieces of deals. I see opportunity for traditional financing. There's also opportunity to use cash. So less, and it really comes down to scale. There's less of a demand for having to find the capital markets opportunities, in my opinion, in the smaller sort of business that I'm in now. But who knows? In a perfect world, I scale up and get right back to that in the future.
Yeah, and I think you hit on a good point, is that there's a ton of multifamily syndications out there, but there's very few once you start getting into other asset classes like industrial, office, or retail. Do you have a focus going forward? Because I know Melcor was a diversified company, so you had investments in every asset class. You specifically, are you focusing on one in particular?
No, and again, that sounds foolish because people want to hear me. They say it should be, and we'll talk about industrial. It should be industrial. It should be multifamily. It should be this. But again, to me, if you're able to harvest in those communities that you know so well, those unique opportunities, I was fortunate enough again to have access to all the different asset classes, and it doesn't make me an expert on every one, but it's given me and the people I'm involved with like opportunities to sort of understand what works, what doesn't work. And so again, for me right now, this building downtown Edmonton was just a perfect opportunity. In spite of what you're hearing about downtown, it's location wise, 104th, 102nd, like
Mhm.
that one made sense. It didn't mean that I'm only, taking the Allied REIT philosophy and buying historical buildings. That's not where I am. But I just think if you understand the market dynamics and you understand the economy, you should be able to filter out at what part of the economy phase a specific asset class may be right for purchasing. I do believe in that. I think that's really important.
Yeah, agreed. And that leads to the next topic of just diving into those asset classes. And just as a prelude to that, I remember watching an interview with Christine Sinclair, the famous soccer player, the women's
Yeah.
soccer player, and she was talking about just some of the questions that she got asked, and she, normal ones like, what does it feel to lead the soccer team and all this. And the funny part that I really got from it is when she was talking about how different, like kids particularly, their young children ask funnier questions, and some of the questions that she got all the time is like, what's your favorite color, and funny questions like that. So I'm going to go along that same vein and ask, what's your favorite asset class?
Well, and I have to tell you, and I'm not saying this because of my relationship with you and that too, Chad, but right now in the world we're in, it's, the industrial market is the darling for a whole bunch
Mhm.
of reasons. But let me tell you why I think that is. And, there were times when office fit into this, and there were times when retail did, but, the world is changing. We're trying to figure out how that looks. Let's be honest. And industrial has maintained throughout all this upheaval. And whether we talk about supply chain or interest rates or the rest of it, what I've also found really cool with the industrial side of things is you talk about, pivoting, which is a real important word during COVID. You look at how, and when I say industrial, I mean, I'm breaking it up between, manufacturing and warehouse logistics, but you see how, those groups are changing the use of the space and how they use it and repurposing space and doing different things.
Mhm.
I take it back to my time when we were buying land in Buckeye and Goodyear for Melcor, so south of Phoenix, sort of southwest, in the middle of nowhere. And it was cheap land, it was residential land. And suddenly, a 1 million square foot Dick's Sporting Goods warehouse went up, and Amazon went up, and Walmart went up, and it changed the entire dynamics of that valley. And suddenly, all that land that was in the middle of nowhere became valuable because people needed to work there. And I like industrial because to me, it always seems to be like the leading indicator of the economic shift. If people are investing in industrial, whether it's manufacturing, logistics, whatever it might be, it's creating jobs. It's creating jobs. Those people are then need to live somewhere, and so it helps multifamily. It helps house. So as folksy as that sounds, Chad, I do. I just think that industrial has such an opportunity. I also, in my experience, I haven't experienced the massive swings in industrial that I have in multifamily, retail, and office.
Yep.
And heck, we're both from Alberta. We know even industrial goes through its ups and downs. But I've just found like the right price product in the right location seems to be fairly consistent. And I find that, as a developer, if you can find that special sauce to create the demand, it just gives you more of an opportunity for longevity of consistent returns. So that's my flag for industrial this year. Like I still think there's real opportunities there.
Yeah, I love it. And I was going to ask a more leading question on why industrial is your favorite asset class, but that would have been a little bit presumptuous. But I'm glad you picked that anyways. So in your pursuit of opportunities, are you more of a ground up developer, or are you going to be on the other end of the spectrum where you're trying to get stabilized cash flow?
Yeah. In my current situation, I think it'll be the stabilized cash flow until I get scale. Ground up development is really cool and fun. I've done a ton of it. Capital intensive. I think you're stuck to the whims of the market a bit more with ground up. We've all experienced the build on spec when the market's good, but miss that market by just a little window, and you're sort of stuck more in your rents. And then we've seen the opposite, where you buy existing, and hopefully you buy quality existing, and find an opportunity to get some cash flow. So for me, at this point, never say never, Chad. But right now, I see it being as existing stabilized assets for the near term, at least.
Yeah, and there does seem to be a pretty big flight towards industrial as an asset class, and perhaps that's just the lingering fear, like you mentioned, of office or retail perhaps having some uncertainty and people not really having a good level of comfort on how that goes forward. So I still do want to talk on industrial and get your
Yeah.
sense on how you'd perhaps look at a deal. But even before that, just to perhaps contrast it, and retail, maybe we could touch on retail if anyone has a specific question on that. So leave it in the chat. Otherwise, I'm going to just focus on
Sure.
office for a second, because I'm quite curious on this one, because you oversaw a pretty big portfolio of office property. What are you seeing in that market right now? Like, with all the uncertainty of people wanting to work from home, whether that materializes or not, do you see that being a persistent trend? And if so, what does that do to the underlying value of office assets?
Yeah, it's so uncertain right now. It's interesting. I look at the research that happened at the beginning of COVID. No one's ever coming back. Then halfway through the COVID, everyone wants to be back, and then no one's coming back. Like it keeps changing. The narrative keeps changing, and without a doubt, office has this uncertain flavor. But now it seems that the flavor is, if people are coming back to offices, they need more space. And if they need more space, that actually helps the office market. So I haven't answered your question because I really don't know. What I've seen, though, even through the Melcor portfolio, a couple million square feet, like there haven't been any real significant downsizes or failures. You have offices that have 1 or 2 or 5 people of 20 that are in. You have people trying to figure out how this flex works and all the rest of it. But at the end of the day, I think that office is not dead. I think that humans are generally social people. And like for me, if I wanted to get noticed at a company, and this is maybe just the folksy side of Darin Rayburn, getting noticed is like passing someone in the hallway or being in the lunchroom or doing the rest of it. And it's funny because I meant you talked about this with Dr. Peter Linneman on your episode a while ago, where he said, if the CEO has to lay someone off, it's a lot harder laying someone off you see in the hallways than someone who's at home. And so I think all of that comes into play, that the office is still an important social side of it. So I do believe office will be fine. I think it'll be different. Again, I think that you'll have more space. I think that the air and the refresher and the HVAC requirements are going to be larger than they have been in the past. But office isn't dead yet.
Yeah, I agree. And someone said it the other day as well. Is it's healthy for the mind just to have some separation of work and home. Like, if all you do is you're at home and then you are technically working, you work all day in your basement or in an office, and that's what your life is, and then you're done after, and you're at home all the time. Like, I think that should be a pretty depressing forecast in the future, to think that you're going to be working out of your house, out of your basement for the foreseeable future, without that interaction and seeing people and talking with people. That's actually a pretty depressing thought.
I agree. And I mean, that's one of the challenges, right? Is we just, oh, sorry about that. I'm still there. There we go.
Yep.
Sorry. All right. Okay. Full disclosure: my daughter, who works downtown, ran across the street. She just saved me. So thanks to everyone for bearing with me.
We should do it. We should give her a shout out.
She just did this to me, Chad. She just did this with her fingers. So anyway, we're good. Yeah, gotcha. So I got distracted. But yeah, the thought of working from the basement, I don't know. Like, for me, flexibility is really cool, but flexibility, able to go downtown and meet you at Sunterra for a coffee is pretty cool, or just walking on the street and running into people. I just think that employers will use the space, again, as I say, maybe in a bit of a different way. And I don't know if I answered your question directly there too, but we've talked about the working from home in the basement. And I know I have some, I had a staff of 125 people, and very close to all of them. And I had some people who say, like, listen, I want to work from home from ever. And some jobs that might be okay. But I remember, we would have a town hall with everyone online at Melcor sort of every quarter. And I'd always say, hey, listen, how you're working now was a reaction to a crisis. It's not necessarily how it's going to be forever. I'm not trying to be a naysayer, but if your job is better served being in an office when we're allowed to come back and it's safe, you're all coming back to the office. And I think that maybe put some people off, because the narrative was so strong about flexibility and a couple days here and a couple days there. So it's going to be somewhere in the middle, Chad. It's going to come back to be somewhere in the middle. But I also think, and I'm just babbling now, but people are creatures of habit, and people are kind of used to being away now. So the bringing back is going to be a bit of a challenge for some people, I think.
Yeah, it's one other thought that occurred to me, and perhaps it's a bit contentious, but I think if your job can be done at home, so if you don't actually need to go into the office and your job is conducive to working at home, your job is really a commodity. And
Yeah.
if employers look at a commodity, they're going to go to the lowest price that they can get that commodity for. So for the people that are working in major markets like in New York or Toronto, and the cost of hiring those employees from working from home is X, call it 80 grand a year, but they can hire somebody in Kansas for 40 grand a year and do the exact same job. I'd actually be worried to have a job that you could do exclusively from home right now.
I agree, absolutely. That's why I think it's in the old days, when I worked for John Love, I worked at Oxford for 9 years. When I worked for John Love, John always taught me way back when: be the first in the office, be the last out, wait till your boss leaves. Like, there's something important about being noticed, and I
Mhm.
totally get that. Thanks to computers and laptops and iPads, you can still be relevant for sure. But again, being noticed and being relevant, I still think that we've all had to promote ourselves in one way, shape, or form to someone, whether it's a client or whether it's a boss or whether it's a colleague or whether it's a spouse. And it's really hard to do that by yourself on a laptop.
Well, and you and I have had coffees before, and as good as this is, and as much as I appreciate you taking the time to do this, I'd much rather be in person with you. I'd much rather be having a coffee or a beer with you in person. So there definitely is a difference. So going back to industrial, and assuming that you're looking in a stabilized asset that has consistent cash flow, or perhaps the ability to value add through different measures, you're chasing an asset class that a lot of people are chasing now. How are you trying to how are you trying to find deals that other people might not be looking for, and what are your metrics and how you're chasing cash flow? Are you doing a projection over a 10-year hold, or are you like a going in cap rate? How are you typically valuing deals?
I find we all talk about cap rates for sure, but I find it difficult because every time we sniff about an interest rate hike, the cap rates kind of move. So for sure, cap rates are important because it all sort of helps us judge the deal. But it's about cash flow and it's about rent steps, because the greatest level of organic growth is a built-in 10-year cash flow with some rent steps in it. It's a
Mhm.
great hedge against inflation. So no, again, I think that's really important to look at that as well. The other side, you asked sort of what am I looking at? I'm going to use this word scalability again too, because for me personally, I'm not going to compete on the Amazon warehouse in Ottawa that sold yesterday. That's obviously not a play for me too. But I still think that there's an opportunity to find well placed industrial, again depending on the client profile that you have with people that you know. Also, one of the things that I've been paying a lot of attention to is there's a lot of you know 12, 14-foot ceiling industrial that we all know, Chad. It's all over the place that people are trying wondering what's going to happen with it because maybe it's not the newest and the brightest and the cleanest. But I've been doing this long enough that I remember when big box retail was getting hammered, and then call centers came to town and filled all the call center space. And now you look what's happening in that state. You have a lot of the vertical grow in the buildings. So I see an opportunity to repurpose buildings. But what's interesting in the industrial side is, like, I don't see repurposing an industrial building into office. Like, I don't think that's. I think it's just using the infrastructure that you have, the electricity that you have to it, the access, the loading, and finding other opportunities. There's a lot of discussion now about these inner city depots, and so yeah, you've got the Amazon warehouses on the outskirts of town, but when all delivery groups are trying to get quicker delivery to the end game, perhaps some of these areas in cities that used to be on the outskirts that are now on the inside of cities, those can be repurposed to something else. There's always a need for space. It's just trying to make sure that it's space that works for the person that needs the space.
Have you looked into physically raising roofs in the past?
Yeah, and I don't want to imply to any of our viewers that I'm a genius on this, because I'm not. I've tried on 3 different occasions, and in all 3 occasions, 2 of the occasions, it just economically it didn't make sense. We almost got to the point where we should just knock down and start over, which is
Mhm.
tough when you see value. In one case, it did make sense, but again, I had to go high enough to get the multi-level stacking. Um, so it's happened, and I know there are people that I know who have done it and done it successfully and did very well. So I'd encourage people to look at those options. But what scares me right now when you look at repurposing, and in the current world we're in, the cost of labor, getting goods,
Mhm.
the time, the supply chain, all the things that we read about every day. I think that is all making it much more difficult to do big retrofits, because I think it's going to more costly and slow things down. But I'm hoping that works itself out over the next 6 to 8 months. And maybe that's a little too optimistic, but what's your sense on that, Chad? Like, is this supply chain disruption, is it going to work through the system for us?
I don't see it happening anytime soon. There's not enough workers to actually distribute this all. Like the ports in Greater LA are still log jammed. They're having a hard time finding truckers. Vacancy rates sub 1% in these big port cities. Like they can't. There's nowhere to put the product, and then there's no way to actually deliver it. So unless we see like a big shift in the economy where we enter into some sort of recession and there's just tapered demand for it, provided that things stay on this current trajectory, I think this is a problem for the next couple of years. It's just going to take that long to get new product online. There's material shortages, there's construction worker shortages to even build this stuff. So I don't see it stemming anytime soon. I think it's a multi-year problem still.
Yeah, and I think again, if you can find that retrofit that doesn't require a significant change, and, if you're just moving some walls and putting some overhead doors, and I know that's idealistic to say because if it was that easy, everyone would do it. But again, I still think there are opportunities. It's just really understanding the market you're in. It's understanding the asset that you're buying, and not getting caught with dead roofs and the rest of it. The other interesting thing too, Chad, is, and we talk about scale, we talk about retrofits and that too. I had someone the other day say, well, why aren't more of the pension funds and capital markets, why aren't they buying some of the old product and retrofitting it because their cost of capital is so low? And my answer is because they don't need to. They can build. Like they can go build the new stuff, and which is what's happening, which is great. And you look at the amount of new space in the Edmonton area, and our vacancy is still as low as it's been in 5 years. So I think the capital markets have made industrial the belle of the ball, which is important. And if there's capital flow and there's cash, I think you'll still get sort of that larger scale, bigger new product. I sense that will continue. So if someone can figure out a way to retrofit the existing stuff that the capital markets and pension funds aren't looking at, I think there's a huge opportunity there.
Yeah, I agree. Well said on that. Wyatt, I think there was a question that came up earlier this week at the top. If you're able to pull that up, is relating to interest rates, which you touched on, Darin. So I'd love to get your thoughts on that. Wyatt, if you're able to pull it up, I just wanted to make a comment on raising the roofs as well, because that is a discussion I had with someone the other day, and kind of the conversation was, figure out what that building would lease for in its current shape. So maybe it's a 14-foot ceiling. Like there's still going to be some economic value to it because not every company needs the cubic footage. Figure out what the rental rate would be with the lower ceiling heights, and then figure out what the rental rate would be if you rectified the ceiling height issue. So you raised it to 24 feet, and figure out what the rate would be there. And then just figure out all the costs that are going to be required to do that. Not just the hard costs, but you're going to have soft costs. You're going to have downtime, the opportunity cost of just not having that rental income for X amount of time. And then just figure it out, a back of the envelope math almost, to see if it makes sense.
Totally.
Sorry, Chad. What was the question? Was it on this link?
Yeah, I think it was the first one, LG, if I'm not mistaken. If you happen to see it up there.
Sorry, I don't see it right now, but if I find it, I'll bring it up. Okay.
Okay, sounds good. Sorry to interrupt you there too, Darin.
No, it's all good. One of the other things too, Chad, that's interesting, which we can't forget about when you talk about retrofitting, greening buildings is really important. People can no longer deny that it's not an important aspect. And a lot of the tenants and potential tenants that I'm dealing with, that's one of the first questions they ask. They're like, okay, great, you can retrofit this old building, but is it energy efficient? Does it fit the boxes that they needed to fix, for the rest of it too? So I think that's an important side of it. And, it's in my experience, I don't want to say easier. Nothing is easy in our business, but it seemed to be a bit more straightforward trying to retrofit those buildings and reduce, your greenhouse gas emissions and increase the lighting in industrial than like an existing old office building where everything's buried in the floors and the walls and the roof and the rest of it. So I think that's important too. I had a conversation with a client out of Toronto who said that, they were very hesitant about even committing to any kind of retrofit because, their company, it's important to them. And so I gave him some advice because it had nothing to do with my company. I said, just ask the question. Say, don't tell me, show me what you're going to do. Like, that has to be part of the lease. Like, write it in. I said, tie the landlord's hands. And I know when I say this, I'll probably get some angry emails from landlords, but tell them that op costs can't go up by more than 1.5%, and tell them that electricity has to drop by XYZ. Because, it's important now, and not that it's always not been important, but I remember talking about a lot of retrofitting 15 years ago, and the general consensus was, that makes sense. But will you pay more rent for it? And at that time, it's like, well, no, wait a minute. Whereas now I sense that, if you actually have a program and you can show results, because measurable results are key to any ESG program. I think that's, again, it doesn't just have to be new buildings. It can be part of the retrofit program.
So on that ESG side, and that definitely does seem to be prevalent going forward, what would you be looking to do in an older building?
Yeah, again, like right off the bat, the low-hanging fruit is, like changing the lights. That's simple. But what you need to do is you need to find a more efficient heating and cooling system. That's where you're burning everything. And, I was really lucky at Melcor Development, so I'll give them a plug here in the REIT. When we were retrofitting the Royal Bank building, we did a cogeneration system, heating and cooling system, and we did it like 9 years ago. So we did it, ahead of its time, and it works okay. It still does what it's supposed to. I mean, the technology's come along so far. But again, the reason we made the investment at that time was we looked at all the costs of all the things that we could do. And as far as, reducing your greenhouse gas emissions, commercial buildings account for 40% of it worldwide. I mean, most of the load, there's the electrical side of it too, but it's the heating and air conditioning. And so I think that's important. And there's some really cool new state-of-the-art systems, and there's a lot of new technology out there that's being tested that can revolutionize buildings themselves. And so, I think that part of it's really important. The other side of it too, and this is perhaps being a bit small thinking, but it's the tenants themselves who occupy the space. So educate them. Let them know. It's not just about the light swipes and that, but all the things that happen, whether it's the water consumption, whether it's anything. I think that's an important side of it too. I know landlords that have done programs that have really sort of promoted that side of it, and they've shown like a reduction in consumption when people are actually aware of it. So I think that's an important side of it that people can't forget about.
Yeah, I think that's a great point. Would you, as a landlord right now, would you be doing that in this hot market where it's a landlord's market and you might not necessarily need to do it to attract a tenant? Would you be doing that as a future value add or just like a social responsibility? How would you be approaching that right now?
I think the social responsibility is important, and that is important. But we're all in it for profit. Let's be honest. So and I think that business has to take a bigger role in social responsibility. That's what we've seen the last 2 years. There's an incredible distrust about the media and about the government, without a doubt. And so business has to take the lead. But I also think, and this goes from my public company experience, because ESG is a real thing. And you can't just back into it. Oh, here, we changed some lights and, we have some minorities in our staff. Like, that's not good enough anymore. And so to answer your question, I think the companies right now that are scrambling are the ones that have acknowledged that it's important, but haven't really done anything about it. And so to me, why kick the can down the road? This is not going to change. And, the ESG side of it, we talk about the environmental side of it and society and the governance. It's all branching out into each of their own sub-branches there too. And you look at someone like BMO Capital Markets now, who actually does an ESG report on every public company that they follow. And there's a scorecard. And it's a simple scorecard. And it's either like pass or fail. And it's interesting because when you see it in those terms, you realize that this is important to people. And again, you can't just wink, wink, nudge, nudge. We've got a cogen system and we'll turn the lights off. There's so much more that you have to do. And I do think getting tenants engaged is an important side of it. And I know as a landlord, you get nervous because you don't want a tenant running your building. But this is part of the collaboration thing though too. I found in my experience, I always thought I knew what tenants wanted. It changes. So I think landlords have to ask more. And that's where it comes into, maybe tenants don't want a cogen system. Maybe there's something more important to them. So it's a much more important aspect than it was before, and it's not going away. So kicking it down the road is like not getting that used car upgraded. And when you go to sell it, it's costing you money.
Great answer. I think I remember the question that came in a little bit earlier, and it just had to do with the spread between cap rates and in an environment where we even see some cap rate compression and an environment where we might see rising interest rates. How are you factoring that into your decisions where cap rates seem to be going down, interest rates at least are being projected to increase? How are you reconciling that?
Well, and it's an interesting question because I think everyone in real estate is trying to figure out how that works. But the gap between cap rates and interest rates is big, even though interest rates are so low. And I don't want to misquote this, Chad, but sometime over the last year and a half, I think the gap, generally speaking, was as big as it had ever been.
Mm-hmm.
And so it feels like there's a cushion there. So we're all expecting cap rates to go up, as I said earlier, when interest rates go up. But I'm curious to see how that happens. The cap rate seems to be most important when you're buying or selling, even less important when you're financing. Because you've been able to sort of work through it and give the story as to why the cap rate may be changing. But when Melcor Developments did development for many years, what we did was our yield return approval rate was based on the gap between the cap rate based on the value and the interest rates. But I'm less comfortable with it being that scientific anymore because we're in the flux. Without a doubt, though, as you mentioned earlier, we saw what the public markets did the last 2 days with just the thought of interest rates going up today and tomorrow. And there is a lot of fear out there, so it'll affect things. But I take it back to a comment I said a couple times, Chad, and I'd love to get your comment on this. Someone asked me, so what has COVID and the pandemic done to real estate? And this is a generalization, but I really feel like it's made the good real estate better and it's made the bad real estate worse. And the only way to really differentiate that is cap rates. So maybe the cap rates in the marginal real estate go up to show that devaluation, but maybe the cap rates in the really good real estate stay low. There's a lot of maybes though, so I'm probably not getting much confidence from people who are wondering what's going with my career.
Well, yeah, it's interesting you say that because I think one of the buzzwords in the office sector over the past 10 years has been flight to quality. That a lot of tenants have been moving to that Class A office space, and it's created challenges for those B and C class buildings. I echo your comments. I think that there probably will be a flight to quality in industrial as well, and we're seeing that a lot of that institutional grade money is chasing those prized industrial assets with the big tenants, where that's leaving a lot of opportunities for non-institutional grade investors. So I agree. I think that will create opportunities on that. And that ties naturally into a question I'd like to hear from you on, to get your answer on is how would a private investor, and perhaps it can be somebody that maybe already has their toe in the water with some industrial, or perhaps it's someone that's just been considering industrial, doesn't have the extensive experience that you do in that space. What would you say to somebody that wants to get into industrial real estate?
Partner with someone who knows about it. It sounds goofy, but you know what I mean? Like I've been really fortunate over my entire career of working with people, being with people who actually understand and can teach. And I think about in 2008, 2009, I spent more time in the US than in Canada, and Melcor was really active buying apartments in Houston and Dallas. And I really didn't know a lot about multifamily, but I spent a ton of time with people who did, and whether it's other developers or brokers or whoever it might be. And I think that's an important part is this. Okay, I got to be careful how I say this because I'm being self-deprecating, not against people on the call, but sometimes we all make this business really complicated. And I'm not suggesting it's easy, but when we talk about the fundamentals that we mentioned a couple of times on this podcast, if you can understand the fundamentals for someone who's an individual investor who's nervous about doing it themselves, I mean, there's all kinds of opportunities. There's a lot of developers like me out there that are doing different syndications. There's, the other side of it, as ridiculous as it sounds, buy into a REIT and get all their reports, right? Because they have to report to you. And so that's the other thing. And maybe you don't have to buy into it. Maybe you can just access it through cedar.com. But the one challenge going back to being a public company is there are no secrets. And so your yields, your development yields, you're it's all there if someone actually wants to do the research. And the other side of it, Chad, and I mean this wholeheartedly, people should be dialing onto these podcasts, your podcast. There's a lot of podcasts out there where, where people are sharing all this knowledge. And what a great opportunity to hear from people that have been doing it and doing it successfully. So I think that's an opportunity.
Well, now I'm going to have to pay your daughter, and I'm going to have to pay you for the shout out. It's going to be an expensive podcast here. That's really well said. I love the point about partnering with someone, because that is a natural way to not only combine resources. If a couple people or more than two people combine their resources, that you're going to have ability to attract or pursue bigger opportunities, but you're also going to tap into their network and their knowledge. So I agree with that completely. I think that's one of the smartest things a first-time investor can do. And then the other point about the REITs, I've owned Melcor, I've owned Prologis, some of the other well-known REITs. I still follow their reports regularly, just because of the market intelligence that they put out is fantastic. So I think that those are two great tips, is to see how you could partner with someone, or three tips: look for a syndicate or get into a REIT. So those are great points. I do want to see if anyone has any questions, and if we've answered everything that people had in mind, then I do want to get your thoughts and your outlook for 2022 and beyond. Oh, actually, we do have a question from TCS. Thanks for the question. Hello, what's your favorite industrial REIT for a long-term hold, US and Canada? Thank you.
Loaded question, and I'm not on anyone's marketing thing, but I'll tell you, TCS, sadly, my favorite industrial REIT was just taken private by Brookfield. It was WPT Industrial.
Yep.
And that's not to mean that there aren't some great industrial REITs out there, because there's a whole host which makes sense. And I think scale is important in any REIT. Make sure that whomever you're buying has enough scale and in a diversified enough market so they can weather the ups and downs. But the reason I like WPT REIT specifically, and yeah, I think it was Brookfield that just took them private, is they actually launched the same time that I launched the REIT. And so I got to know their CEO, fairly well, because we were pitching to some of the same institutions on Bay Street. And we sat on some panels together at the Toronto Real Estate Forum. But I really like their model, because their model sort of broke it down to, again, like, don't just buy to buy. Understand the market, understand the story. Every asset they bought well. But they had a strategy they wanted to execute on, and they wanted to grow in the US. And they were getting into markets that they understood and moved beyond. So again, TCS, it's not good advice, because you can't buy them now because they've been taken private. But whomever you're looking at, again, I think scale is important. I think look at payout ratios. And Chad, I don't need to school you guys on REITs, but the payout ratio concept is this. Am I okay to go through this, Chad?
Oh, I'd love to hear it.
Okay. So a REIT has to pay out a certain percentage of their free cash flow. That's why they're a REIT. That's why there's the tax advantages to do so. And, I'm no accountant, but if someone's payout ratio is 112%, that means for every dollar they bring in, they're paying out $1.12. It's not sustainable. And what some REITs have had to do is sell assets to maintain their distribution. But when you sell an asset, you're reducing your income going forward, so you're kicking the can down the road. And when we launched the Melcor REIT, our payout ratio was about 90%, which seems high, but it was very sort of mid-range. You look at now in the world of COVID and the rest of it, people that are in the 60, 70% range feels pretty good, and down even lower is even better, because it's about longevity. So any REIT you're looking at, just look at their payout ratio history and how much they've gone up and down. And what you want to see is consistency with some growth. You don't want to see this type of thing, because that's just volatility that's waiting to cause some damage.
Yeah, that's a good point. Can you also touch on FFO and even adjusted funds from operation, if you can?
Yeah, and now the adjusted cash from operations, ACF.
Yeah, just to add another wrinkle into it.
I was going to say, and this is where I would definitely need my CFO in a room with me too. But to me, I always thought funds from operation was a truer measure of how the business is doing, right? When you get into ACFO and AFFO, and you're normalizing TI spend and cap spend, and I'm not suggesting anyone does this, but whenever you use the term normalized, it tends to flow things out, and I don't think it's a true indication. And what's crazy is, as public companies, we were required to do all this extra reporting, and the intent through Sarbanes-Oxley and through IFRS, which is the financial reporting standards, the intent is to make it more intuitive for investors, but frankly, it made it way more confusing. Mm-hmm. And so again, even if you look at the AFFO comparisons amongst REITs on the TSX, you have to look into the definition, because not everyone's definition of AFFO is exactly the same, which is confusing. So to me, FFO, it's a little simpler. There's less normalization. You have your cost, your capital cost in there. I think it's just a bit more of a truer indication of how the business is performing.
Yep. I agree. I like the FFO number better than the AFFO as well. But some people do like the AFFO, so it's hard to say. Sure. Thomas, thanks for joining. Thanks for the question. What does Darin think of the commercial industry in Lethbridge, so south of us?
Yeah, Thomas, thanks for the question. So I was raised in Lethbridge. I'm a Lethbridge boy. I actually, for Melcor Developments, bought what used to be called Lethbridge Center, which was the largest, 500,000 square feet. It was a shopping center office tower, the largest assets. We bought that for Melcor Developments, redeveloped it, and sold it to the REIT. And so, I'm a little biased, Thomas. Lethbridge is one of those communities, kind of like Winnipeg, and I also lived for 2 years in Winnipeg, where there isn't a huge boom bust. there's sort of a consistent moving along. Now, Lethbridge is very tied to agricultural community, so that's a good side of it. So while there aren't big sways, I mean, the Melcor is a company, the Melcor REIT has been very active in Lethbridge for a long time. So I think, Thomas, that gives you an indication of sort of my view on that market. And again, it's, 100,000 people, but it operates a bit smaller. And that's not a criticism, that's actually a compliment, because I think you can understand growth trends. And, Melcor Developments, way before I was around, they've been developing residentially in Lethbridge since 1973. And you could see the growth patterns geographically, and some of the land that people like Ralph Young and Tim Melton and Neil Johnson bought, way back when, that seemed to be in the middle of nowhere. Melcor is now very actively developing. So they were able to flow that development path. And you always have to be a little bit lucky in residential development for sure. But I just think that the Lethbridge market has legs in it. It gets criticized for being quiet, but I don't see it being quiet in a bad way. I think that you can buy there, you can buy right, and be profitable.
Yeah, good answer. I'm pretty sure Thomas is quite active actually in Lethbridge. So it's leave a comment. Let us know how you're finding things being on the ground as well. Question from Kevin Gardner. What type of debt is utilized on assets typically? 3 questions actually. I don't know if you can see it on your screen.
I can,
Darin.
yeah.
Okay, perfect. Debt used to finance acquisition or buy in cash, and interest only facilities are amortized. And
Yeah.
thanks for the question there too, Kevin.
Yeah, thanks, Kevin. Great picture too, by the way. I think we talked a little bit about that earlier, but I'll sort of sum it up in a different way too, where from the REIT, I'll talk about the REIT perspective, the development perspective, because there's more going on there too. So the typical asset financing and the debt that was used was traditional mortgage finance, and because you're getting 10-year money at 2%, 2.5%, like it made sense to do that. So I think that was an important part of it too. But I'll tell you how Melcor Development was successful in growing prior to the REIT. So when I started in 2002 and we were buying assets, we were buying them with cash. And I'll tell you why. It was cash, quick close, and we demonstrated you can get a better deal. Like you just, in those days you can. And so we would buy with cash to get control and then finance after the fact. Now that's great for a $2 billion company that can do that. Not everyone can do that, but I think that's important. I'll tell you what else I saw in every asset class that became important, depending on who you're buying from, is there was a lot more opportunities for vendor takebacks. Someone wanted to sort of get out of the market, and you'd pay a premium to the interest. And I know that doesn't make any of our finance companies very happy because they don't want to do that. But I saw that as a good short-term bridge. Do a VTB for a year or two or something to sort of figure out what you need to do, especially if you want to stabilize an asset. What a great opportunity to buy something, still finance it so you can have some free cash flow to stabilize it and move forward. The interest only, I did a lot of that in the United States because it was very prevalent. Melcor doesn't do a lot of that in Canada because, as a conservative company, we like paying down some of the principal. And a lot of our analysis on our buildings on how they did, it wasn't just the cash on cash return, it was the cash on cash with principal pay down, because we thought that was an important side of it. So I'm curious to see how the lending market is going to change going forward. I have seen, again, we talked about the good real estate being better. I've seen lower rates, less recourse requirements for the good real estate. And I found it, no matter what company you are on the, I don't want to say lesser than quality real estate, but maybe not the trophy assets, it's getting a bit harder to finance, but there's always a new vehicle out there to figure it out. So Kevin, I think what's great was for me as a public company CEO and also as now a private developer is that there's a number of options out there that can sort of fit your time horizon and your interest rate appetite.
Yeah. Thanks for the question, Kevin. If we've got 5 minutes left, so I do want to get your closing thoughts on that. If anyone does want to sneak in a question, I'm pretty sure we could get one more in. But closing remarks, Darin, on what you see for balance of 2022 and perhaps even a medium to longer term outlook on, and you can address this from either a commercial standpoint generally, an economic standpoint, industrial real estate, even from your own perspective. I'll give you free reign on how you want to address that, but a forecast for the rest of the year and beyond 2022.
Okay, I think I'll sort of keep it granular. We'll talk about sort of Alberta for now, because I think that's how I've been talking a lot lately. My own opinion, I feel like the narrative on Alberta has changed. And what I mean by that was, whether it's from Bay Street or investors, it was, even before COVID, we had an oil recession. People were like, oh, there's a lot of vacancy in downtown Calgary. There's a lot of this, there's a lot of that, blah, blah, blah. It feels like there's a couple of things that happened during COVID that caused interest to peak up. And I got more calls in my last, 2.5 months at Melcor, again, from Bay Street or foreign investors than I did the prior 2 years. And so a couple of things happened. I mean, obviously oil, right? Oil's up. That feels pretty good. We know the oil companies aren't necessarily investing it in capital, but they're cash rich. And so that was an important narrative that's changed too. And, there's always a double side to oil, but we'll get back to that. Number two, when that American firm, is it Oak Street bought from H&R, they bought the Bow in Calgary, the Bow Tower, and then that building in Chicago, 2 years ago, that opened people's eyes to say, well, they're buying the biggest building in Calgary. Like, that's a bit strange. But I think a lot of pundits said, well, they also wanted the U.S. building, so it was kind of a bundled asset. Okay, fair enough. But then 2 months ago, they bought the other asset in downtown Calgary for $475 million on its own. And what I found is suddenly I was getting calls from my capital markets contacts saying, what do they see that we don't? And herd mentality, right, Chad?
Yep.
Like, it happens. And so I think that was an important part. I think, we know what we're talking about. Jack Mintz did an article in the Globe and Mail, I think a couple of weeks ago, that's called like Alberta getting its mojo back. I mean, that was important. And what was cool about his article is he didn't just talk about the good. He also talked about, the challenges we still have. But I think that was an important side of it too. But, there's a lot of talk about energy, and fossil fuels aren't necessarily bad. It's the combustible fossil fuels that the world is having challenges with, for sure. And there's a lot of talk, about hydrogen, and one of the things, I'm embarrassed I don't know enough about it, and I'll tell you in the next 60 days I'm going to learn, because out in Fort Saskatchewan we have the largest carbon capture facility in North America, perhaps the world, and it's something that as people in this community we should know about. And we hear about the coal being shipped to China and the rest of it. What if we can use this research and technology and come up with a way to keep our fossil fuels clean? And let's export that. I think there's going to be a huge change. And so I think that's why the narrative has changed for Alberta. There's still a wait and see attitude for some groups, but again, I see a lot of foreign investors who are looking again. And let's be honest, for those of us that have been in Alberta our whole life, like, we've been through this before. I'm not suggesting we've been through COVID, because that's crazy, but when I had to do a report when I was retiring on sort of like my last 30 years in the industry, and I counted the cycles, and I think there's like 8 or 9 that I've been through where it's up, down, up, down. So again, I know that we have some pain and uncertainty. It feels a lot better now than it did 6 months ago. And if it didn't, Chad, I wouldn't have retired. Like, the fact that I actually left to go in this market, I think there's a real opportunity there. So I think that's important. I'm really encouraged how the economy has shoots of green growth. They've sort of learned how to live with everything else we're dealing with. And I'm encouraged by the entrepreneurial spirit and the human spirit. And, people are finding ways to find opportunities. And this is stuff we always talk about. We're actually living it. I mean, here we are in the 5th wave, and maybe the 6th is coming, and who knows. But, what I'm feeling is that there's finding ways to figure this out. So I'm encouraged. I'm discouraged at the pain and suffering the last 2 years, for sure. But I'm encouraged that people are sick of waiting for something to happen, and we're going to make it happen. And I think you can take that narrative beyond Alberta as well. But, the flip side, like, I get it. There's still all kinds of uncertainty. Interest rates, I think for me right now, that is the biggest, more so than Omicron and everything else. I think it's the interest rate side of it that scares me, because if you look historically, if the governments do not respond in small locksteps, then they try and just do a big catch up, that just kills everything. So while I don't want interest rates to go up, Chad, because it's going to cost me more for lending, I kind of hope it goes up a little bit, because I think that if it has to go up, if inflation isn't going away, we need to sort of find a balance without a big move. So I'm encouraged. And then the last side of it too, all I know is there's lots of capital out there. There's lots of capital sitting on the sidelines. And, we talk about industrial. When industrial became the darling of the capital markets, it helped that economy. And so, if we can find a way to get that capital placed and get people working and jobs going again, I think there's nowhere to go but up. And heck, if we can get through the last 2 years and we're still here smiling, trying to figure this out, I don't know, I hate to say this, maybe we can get through anything.
Yeah, I mean that's the one thing that I've taken from this is that the human spirit and the resiliency is impressive, because that has been a crazy 2 years that we've all gone through, and I think that this year is still going to be a bit of a roller coaster. I have really no idea what to expect, on whether we see another variant and that spooks everybody, or we see a massive hike in interest rates. I think it's still going to be a roller coaster mentally and emotionally in 2022. But I agree. I think people are still going to take the mentality. Let's move forward. We can't just sit on our hands all the time. Let's move forward, and it's much more fun.
Look what we've gotten through. Like, if you look at the last couple of years, and like, social economic upheaval, like political upheaval, like it's crazy, the things. And I kind of lose track of the last 2 years because we've all been doing this. But yeah, like getting through that and looking forward, I just think that there's gonna be lots of volatility. I don't know what the new normal looks like, but I think normalization is agreeing we need to get back to work one way, shape, or form. That's gonna happen.
I'll also feel a little bit more normal once you and I can get together and have coffee or a beer in person. That's when I'll know. I'll say, okay, we're back to normal.
Absolutely.
Thanks so much, Darin. Appreciate all your time and insights. I love chatting with you, and let's keep in touch.
Chad, I appreciate you, and thanks everyone for bearing with me with my no plug and getting saved by my daughter. And Chad, the other thing I want to say, just a shout out to you. Honestly, you've perfected this model, and the information you're sharing is invaluable. And if people aren't thanking you enough, let me thank you to begin with.
I appreciate that.
Keep it going, and perhaps we can chat in the future, and I'll actually have my logo on the wall, and I'll have my head positioned properly, lighting right. But I really am thankful you had me on this, and I hope that people gain some knowledge that's useful to them going forward.
Well, I certainly did, so I'm sure others will as well. So thanks again, Darin. Really appreciate your time.
Thanks a lot. Take care, Chad.
Take care.